Chinese have completely grind the imports to a halt in August. We expect also very low imports of U.S. crude oil into China next month.
Oil wasn't stolen. It wasn't blocked or bargained away. It was quietly written out of the deal. By mid-2025, China had stopped buying American crude almost overnight. One of the biggest energy trades in the world, gone without warning. No headlines, no last-minute talks. A 10% tariff landed, and that was it. While Beijing doubled down on long-term supply from Russia and Iran, Washington kept chasing old fights. They were busy arguing over Canadian lumber and obsessing over wind energy. Tankers idled, contracts dried up, and the White House still hadn't noticed what slipped through its fingers. So who fills that vacuum now? What happens when the largest energy buyer on Earth decides to look the other way? And does anyone in America even realize what's already been lost? In early 2025, things were still running on momentum. Ports along the Gulf Coast loaded barrels. Pipelines flowed with confidence, and terminals operated as though the world still needed American oil like it once did. China had long been a steady buyer, pulling in about 160,000 barrels each day. That volume alone had helped justify massive investments in export facilities, port expansions, and new trade routes. It wasn't record-breaking, but it was stable, predictable, and enough to build around. Then something shifted. A quiet policy decision landed in Beijing. In February, China added a 10% tariff on American crude. That small change, delivered without speeches or warnings, triggered an immediate freeze. The orders stopped without fanfare. Even discounted barrels failed to move. There was no official announcement, no economic retaliation, just a pause that never ended. The oil sat still. Storage tanks, once flipped weekly, stood half-used. Pipelines built to supply Asian markets slowed to a crawl. Infrastructure that once hummed with purpose now sat idle, underused, and half forgotten. This wasn't an act of sabotage, it was far more calculated. China didn't close a door, it opened new ones elsewhere. While American leaders were still focused on internal battles, Beijing began securing long-term energy partnerships. Russia, Saudi Arabia, the United Arab Emirates, Iran. Every deal locked in volume, every contract priced competitively, and nearly all of it handled in yuan. The greenback was gone from the table. And these weren't short-term discounts. These were foundational shifts, restructuring supply lines, changing shipping lanes, adapting refinery specs, and rewriting financial networks to work independently from anything tied to the United States. In Washington, the response was nothing short of disconnected. While Beijing rewired global energy logistics, American leaders were tangled up in lumber disputes with Canada and taking swipes at wind energy. Public messaging remained glued to slogans from 5 years earlier, as if the global marketplace had frozen in time. But oil doesn't wait for politics, and trade doesn't respect nostalgia. North of the border, Canada wasn't sitting still either. Neither was Mexico. The two nations began work on the Northern Corridor, a massive logistics route designed to bypass U.S. ports entirely. Billions poured into alternative trade lanes, allowing goods to move between the Atlantic and Pacific without ever touching American soil. More than $120 billion in annual commerce began rerouting through infrastructure that no longer relied on U.S. systems. The goal was sustainability, keeping supply chains flowing while sidestepping the volatility brewing in Washington. The United States, once the center of trade, now looked more like a middleman being phased out. Allies were no longer waiting for clarity. They were linking arms and moving forward without it. The silence from traditional partners wasn't aggressive, it was strategic. The phone stopped ringing, the inbox stopped filling, no press conferences, no debates, just quiet exits from the room.
We'll make America strong again.
China, meanwhile, didn't pause to reconsider. It moved forward quickly, finalizing agreements that rewrote the rules of global energy trade. By July 2025, most of its long-term oil deals were locked in with Middle Eastern and Eurasian suppliers, and the US dollar was nowhere to be found. The yuan became the standard, and with it came a recalibration of global financial power. Every barrel that flowed under a yuan agreement reduced the dollar's reach. Every transaction that bypassed U.S. banks made American sanctions harder to enforce. Washington's grip on global trade wasn't broken. It was being worked around. Iran, often the target of sanctions, became a quiet winner in this shift. While Western officials attempted to isolate it, Tehran built a backdoor system that delivered millions of barrels to China through a shadow fleet of disguised tankers. Small, independent Chinese refiners welcomed the supply. These were agile buyers, unconcerned with politics, interested only in affordability and flexibility. By the middle of the year, China's Iranian imports had surged past 1.7 million barrels a day, 10 times the volume it once bought from the United States. The shift was structural. While Washington clung to the notion of leverage, global buyers were writing a new playbook. American crude was being priced out, not just economically, but logistically. The supply lines changed, the refineries adapted, the financial systems reoriented, and all of it happened without a shot being fired or a headline warning of collapse. At home, the mood was surreal. Export terminals in Texas, once a symbol of American energy dominance, had become costly reminders of a misread market. Billions had been invested in docks, pipes, and storage. These were facilities built for a Chinese market that had moved on. Some operators tried shifting barrels to Europe or India, but those markets were smaller, slower, and unwilling to match China's scale. The math no longer worked, and no policy slogan could fix the fact that the biggest customer had left the building. Even China's strategic petroleum reserves began to outpace American benchmarks. By the second half of the year, their reserves could cover more than 3 months of imports, well above global averages. While the United States debated whether to refill its own reserves at all, Beijing had already filled its tanks with discounted crude from Russia and Iran. These weren't emergency supplies. They were tools of negotiation. Full reserves gave China leverage in pricing, flexibility in shocks, and confidence against pressure. No sanctions could dent a deal that never touched a dollar or passed through a Western system. All of this unfolded while the U.S. president continued promoting outdated trade victories and pointing fingers at wind farms. The energy policy had stalled in place, untouched and outpaced. Back in Asia, Chinese ports processed record volumes, refineries operated at full tilt, and tanker routes adjusted to fit the new norm. And every part of the process had been calibrated to keep American crude out of the equation. This shift wasn't isolated to China. India began expanding its own contracts with Russia, locking in low-cost barrels in deals priced outside the dollar. Southeast Asian nations tweaked their purchasing models to align with flexible payment options. And in Europe, American oil was still moving, but under heavy pressure. Buyers demanded lower prices, longer terms, and looser restrictions, using the competition to rewrite their own terms. The old model of American energy dominance didn't disappear overnight. It unraveled slowly, thread by thread, deal by deal. What had once been framed as influence turned into irrelevance. Global buyers stopped waiting for Washington to catch up. They created alternatives, and those alternatives worked. They offered reliability without political strings, consistency without drama, and pricing not vulnerable to shifting U.S. policies. So what happens when global trade moves forward without looking back? What does it mean when signatures that once held weight are no longer required? Drop your thoughts in the comments, hit subscribe, and stay with us as we follow what comes next.